All right, we're live. So back to the S&P. Today, it had a sell-off pretty much exactly in line with what I thought might happen last night. I had the audacity to claim that it could be a buy the news, but then sell the realization sort of reaction, and that's what happened. But not before, not before we went to all sorts of ridiculousnesses in that's not a word in the night session. So let's take a look. If you've been following my channel, you know that I was bearish here. I sold. This is amazing, though. Just this ramp. That looks mechanical to me, right? That looks algorithmic. So somebody was buying algorithmically last night. Topped out at 47.50. You know, if you were awake at 5 a.m., 5:30 a.m. Central, and you shorted this, kudos to you. You're the big winner today. Because it was a one-way ticket basically down. I hedged here at 46.50. That trade was nice. Took it off at 46.70. So that was the main kind of win for the day, actually, for me. And now here we are. It's 7 p.m. and we are at 46.73.5. We're flirting with this 46.70 line. Which has acted as support and resistance for a really long time. Let's zoom out to, that's too zoomed out. Let's zoom out to a 2-hour chart. And you can see it goes all the way back to this 46.70 line, goes all the way back to November. The beginning of November is when it was first acting as support. And then here in mid-November, late November, end of November, and then boom. Unlocking that here was acted as resistance and then coming all the way down. So 46.50 seems to be another important point at this moment. It's where we were when the Fed, right when Jerome Powell started his presser yesterday. You can see it got used as a top here as well, a bottom here. So and then a bottom today. So 46.50 and 46.70 are these two important price points. Now, the most likely thing that happens tomorrow is that we get pinned at 4,700, that we rally back to 4,700 and get pinned there. $4 trillion in options expiration rolling off tomorrow morning. Tomorrow, between tomorrow morning and tomorrow at the close. The second most likely thing, thing is that we kind of bounce around between 46.50 and 46.70. I think there's also a significant chance we find our way down to 46.10 and maybe even break that. And so I want to list 3 reasons why we may not be out of the woods yet with respect to tomorrow. And they are: 1, we did settle below the support line at 46.70 on the daily today. Now we're back up above it, but that was, in my mind, a significant break. I came on and I said, when we were right here, I said, we're kind of at this decision point. And in the heavy volume hours, we could not regain that level. That to me is significant, and it's bearish. Right now we're playing out this sort of triangle thing here. Like, I guess I could draw it in, where we've got, this kind of deal going on and this kind of deal going on. So we're compressing this triangle. Anytime you see a big sell-off like this followed by a triangle, that's generally bearish. So the whole fact that we closed below 46.70, though, in my mind, is not a positive. That's a bearish thing. As I said yesterday, we may have had a reflexive buy the news from the Fed meeting, only to be followed by an oh shoot moment as the market looks down into the yawning chasm of doom. And the yawning chasm of doom, do you guys know what the yawning chasm of doom is? Do you know what I'm talking about when I say that? It's this. This is the yawning chasm of doom. All right. This is the yawning chasm of doom. We're up from, 665 we bottomed at, and now we're at 4,664. For those of you that aren't good at math, that's about a 600% increase. Shiller PE ratio. We have gone from 15, which is not really technically all that low, up to nosebleed level of 39 as of when? As of 4 p.m. today. Okay, 39.17. Not quite to the ridiculousness of the 2000 bubble, but we're close. And, the only other time, I'm going to say the only other time we've been this high, returns over the next 10 years weren't good. Black Tuesday, it's been few and far between that we've been at 30 or above in the Shiller PE ratio. Not a good time to be in the market. So that, when I say the yawning chasm of doom, the stock market is up by 600%, whereas earnings are up only, only about 200%, a little more than 200%. So everything else is just excessive valuation. We don't now. Of course, it's a more complicated argument than that. I get it. But any way you look at it, this is an overvalued market. Plus, we got that whole quarterly sell tail still there, and we got the monthly sell tail still there. Right? Those did not go away, and they could still be in play. So, last reason is that the market leaders are underperforming. So, Apple, number one. I actually did the math on all these today, so let me pull that up. All right, last Thursday was when I came out kind of bearish, well, very bearish rather. Since that time now, Apple is down 1.26%. We broke below that 175 level. We closed in these buy tails from the past 2 days. Not good. Not good. Microsoft closed, it looks like, below the 50-day moving average in the buy tails of the previous 2 days, down 2.46% from last Thursday. Google closed below the 50-day moving average and down 2.19% from last Thursday. Amazon closed, that doesn't look that bearish, but we're back below the 50-day moving average. That's not good. Right at the 200 and is down 3% from last Thursday. And Tesla, the underperformer of them all, well below the 50-day moving average, closed below yesterday's tail, closed below the 12.6 tail, and we are down 7.7% since last Thursday. That's an average of 3%. We're down 3% on average on the top 5 stocks in the index. And they make up a serious amount of the index. Meanwhile, the S&P is flat. We're down 0.17% from last Thursday. So why is that significant? Because this is a market of market leaders. It matters what the top stocks have done. That's what's kept this rally alive this whole time. And now those things are down top 5 stocks are down 3.3%. If the S&P was down 3.3% from last Thursday, that is what is that? 3.3 times 46. I'm going to say it's about 160. Let's do it. 151. 46.6. 154 points. So from last Thursday, down 150. So that would put us right at 45.12. 45.12 is right here. So if the S&P tracked those top 5 stocks, would be down at 45.12. And my thesis is they're market leaders. So what they do, the S&P is going to follow. This thing's overvalued. We got to sell. Oh, I got a fourth one. We got a big old fat sell tail back above 4,700. How do they not count that? We got a huge sell tail, right? We got a huge sell tail. And we're going into OPEX tomorrow. It's going to be fun. It's going to be a blast. It's going to be fireworks. We're going to see fireworks tomorrow, guys. We are going to see fireworks. All right? It's going to be great. I know I had one other thing. I know I did some sort of analysis of vol. Let me share that real quick. So I'm not saying that this, well, you can take from this what you want. Basically, this orange line is realized dollar vol. I'm sorry, realized hourly vol in the S&P. Okay, the orange line is how much was the stock market actually moving, and the hourly bars are what. So in an hour chart. So it's sort of like a very short-term view of stock market realized volatility, how volatile the stock market actually was. The blue line is VIX. So that's what people are willing to pay for protection. Implied volatility. Realized volatility, implied volatility. Realized is orange, implied is blue. You can buy the blue. You can't buy the orange. The orange is just what happens. The blue is what is forecast to happen, and it determines the pricing of options. Okay. Now, when realized is above implied, my contention is that options are a better deal. Okay. Because why? Because the pricing is based on implied. So if you're in a realized, what's the word I'm looking for? If you're in a, I can't think of it, but if you're in a regime where the realized vol is higher than the implied vol, then even if you're wrong, right? Even if you're wrong about the direction of the price movement, you're actually not going to lose as much money. And or that's not always true. And or you're more likely to get a size of move, right? Like if you have a way out of the money, a womb call or put, you're more likely to get a move that makes you a multiple of your money, meaning you do very well. Okay, so right now we have seen over the past 3 days this realized vol climbing and then spiking. Now, ironically, this big spike was because of a rally in the S&P. That was in those 2 hours yesterday after the Fed meeting. But we have now sustained that, and you can just see it visually. If you just look at an hourly chart of this sucker, you can see that we're starting to make bigger moves again. Now, the biggest moves came back here when everyone was afraid of Omicron right after Thanksgiving, okay? And then things settled down. There was an all clear sign. This was that huge gamma rally. And then look at this. I mean, vol really, really settles. It starts to spike up here, big spike. And so now where are we? Well, we're in one of two places. We're in a place where we get a pin and vol just absolutely dies, or we're in a place where vol continues to expand and a lot of people are caught flat-footed. When I say a lot of people, I mean more analysts than I mean people who are holding. But in that scenario, if vol increases and price plunges, you're going to see it be a very, and this is why I say fireworks, you're going to see it be a very self-fulfilling prophecy, because dealers will be forced to sell into the expiration. And then as soon as the expiration is off, that force reverses if this happens, right? This is if a big sell-off occurs tomorrow morning. If a big sell-off occurs tomorrow morning, when those options come off, the dealers need to cover their hedges, okay? So we can see a big fireworks tomorrow. All right. Well, that's it for tonight. Wow, 14 minutes. I got to make these shorter. I hope you enjoyed it. And yeah, stay tuned. Cheers.